Today's video will serve as a review for you for topic 7. You'll have a test very soon over this topic, and I think I want to give you kind of a synopsis of what topic 7 covered. We're looking at ways of determining cost of the goods that a business sells. And sometimes it's more difficult than one might think because we buy items at different prices at different times, and the items that we sell get mixed up. Sometimes it's difficult to determine exactly how much we paid for an item that we end up selling. So we need to have a method of determining that, and we need a method that is acceptable through the generally accepted accounting principles that we have talked about earlier. So we talked about something called first in, first out. We talked about something called last in, first out. And we just talked about something called average cost. These are different methods of determining how much the items that we sell originally cost us. So let's take a look at the screen and we'll look at some examples. First of all, I want to point out this line here. These are methods, we're looking at methods of calculating the cost of goods sold and the valuation of the inventory for a retail store. All of our examples in topic 7 have dealt with retail stores. These are businesses that buy items already manufactured. So we may be selling toys, for example, so we buy a toy that's already manufactured, put together, it's in a box, and we buy it from a supplier and then we sell it at a higher price. So this is how retail stores obviously work. They don't manufacture the item. Later on in this video, we'll take a look at a company that actually manufactures the item and then sells it. And we have to handle that a little bit differently, as we'll see. But right now, this example deals with a retail store. So look at the top part of the screen first of all. You see that this particular company, on 3 different dates in the month of January, bought some items of inventory. On January 7th, they bought 50 items that they purchased for cash at $1 a piece, totaling $50. On the 14th, they bought 60 more items. This time it went up a little bit, each item at $2 a piece. So the total we spent at that point was $120. And on the 21st of the month, we bought another 40. And this time the price went way up to $10 a piece, costing us $400. This isn't what we sold the items for. This is what we paid for them. Now, the total we bought during the month was 150 items, and the total amount of money is $570. And as this indicates, this amount will be debited to the inventory account. Actually, all 3 of these amounts. And we'll take a look at that at this point in just a second. First of all, one more transaction we'll talk about when we look at the books. January 25th, we sold items. We sold 30 of them for cash at $12 a piece, adding up to a total sale of $360. So you should be clear now how you handle this in the books of the ledger and the journal as far as that goes. But we're going to look at just the ledger at this point. So down at the bottom, I see a tab, and we'll look at some selected accounts in the ledger. After we've journalized that information, if we go back to these 3 dates, each time we would have put an entry into the journal and then posted it to the ledger. And if we did that correctly, this is what it would look like. Let's take a look at the accounts we have here. We will assume we had some money to begin with in cash. So we had $10,000, and we will just assume that it came from journal page 12 and everything else came from journal page 13. So the journal isn't shown here, but this indicates that all of these entries into the ledger have come from the journal. So let's take a look at what this means. As you know, we bought those items of inventory for cash. So on the 7th, the 14th, the 21st, we have 3 credits to cash. because cash went down. We spent money for those items of inventory. Over here in the inventory account, we have the same 3 dates, the same 3 transactions, and each one is debited. The inventory went up, and it adds up to a balance now, a debit balance of $570. If you go back to our original page, we bought $50 worth on the 7th, $120 worth of items on the 14th, and $400 worth of items on the 21st, adding up to $570, and that's what we see here in the inventory account. So very simple. So those 3 have been put in. Then back here on the opening page, we see that we made a sale on the 25th. We sold 30 items at $12 a piece for $360, and that also has been journalized and now posted to the ledger. You see cash went up by $360. We gained cash, so that increased cash, and then sales was credited by $360. We made a sale. We could put the number of items in here if that was necessary for us, but not necessary for our purposes here. We do need the total amount of sales, $360. Now, the difficulty we have from the very beginning of the course, we've had this kind of transaction a lot where we made cash sales. The point that I want to make here and reinforce to you is that we made a sale, but that transaction where you debited cash, credited sales, does not impact inventory. Now, if we sold, and we did, if we go back to the first page, we sold 30 items. But that's not deducted here in inventory. So we don't have $570 worth of inventory anymore because we sold some of it. So we need to account for that. That's the whole crux of topic 7. Now, if we use FIFO, this company uses FIFO, first in, first out. Let's go back to this page and look at finding cost of goods sold using first in, first out. If we sold 30 items, we sold the first 30 that we bought. We bought 50 the first time, and we sold 30 of them, and that would be $1 a piece. So the cost of goods sold is $30. And this shows ending inventory of $540. Let's take a look at what would happen here, first of all in the journal and then eventually in this ledger. The entry would be a debit to cost of goods sold expense of the $30. That's the cost of the goods sold that we just figured using FIFO. The debit goes to cost of goods sold expense. The credit goes to inventory. And you see what happened to the balance. It's down to $540. Now we have taken care of the items that we sold. We sold them for $360. They only cost us $30. And so we have to use FIFO in this case as a debit to cost of goods sold expense, a credit to inventory, leaving us with a balance of $540. And that corresponds back here to my $540 in ending inventory. To follow it through, gross profit now is sales minus cost of goods sold. So the cost, or the gross profit in this case, using FIFO, is $360 minus 30, meaning a gross profit of $330. If you look at the accounts, you can actually see that. Sales is $360 minus cost of goods sold of $30 would give us the $330 gross profit. Let's take this out. Let's take this out. If we go back and use LIFO, this time last in, first out means that we take the 30 items that we sold from the last group of items that we bought. And they cost us $10 a piece. So that means those 30 items at $10 a piece cost us $300, a lot different than using FIFO in this example. So if I do that, again, my entry would be cost of goods sold expense by $300, and not 30, but $300 here in inventory. And that leaves me with inventory of 270, which corresponds to what we see over here of 270. The gross profit now would be the 360. We still sold 30 at 12 bucks a piece, 360 minus the cost of goods sold of 300, giving us a profit of only $60. So the difference between FIFO and LIFO in this example is huge. The gross profit would be a lot different. Finally, if we go back and take that out and take this out, and we go back and look at the average cost, the average using average cost for determined cost of goods sold, we simply take the total amount, the 570, the total amount that we bought, divide it by the total number of items that we bought, and that's what is expressed here in a little formula. You divide that, you get an average cost of $3.80. So those 30 items we sold cost us 30 times $3.80, $114. So that cost of goods sold entry would mean a debit to this expense account again of 114 and a credit this time of 114 using that method. You don't use all three, you use obviously just one of the methods. This leaves us with an inventory balance of 456 that you see here. And the gross profit again is the 360 minus the cost of goods sold of 114 and leaving us with a gross profit of 246. The key will be after you've purchased your inventory, in this case with cash, we purchased 3 items of inventory, and after you made your sale, this time a cash sale of 360, then you need to make this entry of 114 debit to the expense account and credit to inventory was using the average cost method. If we use FIFO and LIFO methods, it's the same entry but a different amount of money. But again, the method chosen by the company will determine what your gross profit will show and what your ending inventory will show. They'll always be a little bit different. Go back and review this a couple of times if you need to, because it's important to get this straight so you understand exactly the relationship here between among the 3 different types of methods of determining cost of goods sold. Finally, I want to look at this tab at the bottom. If you're looking at a manufacturing company, they don't buy the item already made. They have to manufacture it themselves. So the only thing I want you to do, we won't have problems with this, but what I want you to know is that when you determine the cost of goods sold for a manufacturing company, these 3 things need to be considered. The labor needed to manufacture an item, the materials needed to manufacture that item, and then overhead. Overhead is a percentage of things like electricity, heating, and so forth, the things needed to actually manufacture the product. You add those 3 up, you'll get cost of goods sold. So these 3 items you need to understand. We, again, won't be doing specific problems with this type of company, but you need to know that if it's a manufacturing company, you need to consider labor, you need to consider materials, and you need to consider overhead. At this point, I'll ask you to go back to your course page and answer some questions.